Starting a business from the bottom up is no simple job, and many entrepreneurs have the dream of taking their nascent startup and turning it into a financial success. The journey from zero to hero is long and often loaded with dangers and rewards. It demands devotion, strategy, and an in-depth understanding of the financial side of running a firm. Is this voyage a smooth one or not? Stay with us as we take you through this amazing trip. And don't forget to hit the subscribe button for more motivational videos. Let's get started. From understanding how to appropriately spend finances to ensuring adequate cash flow, entrepreneurs must be able to navigate the ever-changing business landscape in order to effectively traverse their financial path. With the correct coaching and resources, any entrepreneur can take their firm from zero to hero and attain their financial goals. What is the financial path of a startup? The financial journey of a startup is the process of turning a fresh business into a profitable one. It entails understanding the foundations of business finance and making wise judgments about how to distribute capital, assure cash flow, and manage risks and rewards. It also entails constructing a financial strategy and setting financial goals, as well as investing in the correct tools and improving financial literacy. Understanding the foundations of business finance. Knowing the fundamentals of corporate finance is the first step in a startup's financial journey. This includes comprehending the numerous forms of financing choices, such as debt, equity, grants, and venture capital. Understanding the numerous sources of finance is vital for entrepreneurs wanting to get investment for their startup. Additionally, entrepreneurs should have a fundamental comprehension of financial statements, such as the income statement, balance sheet, and statement of cash flows. This will help them track the financial performance of their organization and make informed decisions about how to allocate finances, how to allocate funds for a startup. Once entrepreneurs have a basic understanding of business finance, the next stage is to select how to distribute capital for their startup. This entails evaluating which sections of the firm need the most financial support and distributing funds accordingly. For example, entrepreneurs should consider devoting expenditures to marketing, product development, and research and development. Additionally, entrepreneurs should examine how to divide capital for operating expenses, such as salary, rent, utilities, and other overhead costs. Finally, entrepreneurs should also decide how much of their capital should be used for investments, such as stocks, bonds, and other assets. Ensuring financial flow in a startup. Ensuring proper financial flow is vital for any startup. Without proper cash flow, firms can easily run into financial problems. To secure adequate cash flow, businesses can seek strategies to boost revenue, such as offering discounts, releasing new items, or expanding into new markets. Additionally, entrepreneurs should also seek for ways to minimize costs, such as renegotiating contracts, streamlining processes, or outsourcing specific services. Finally, businesses should also examine strategies to enhance their access to finance, such as applying for loans or seeking out investors. Managing business risks and rewards. Every business initiative entails some degree of risk, and it's crucial for entrepreneurs to understand how to manage risks and rewards in order to maximize their chances of success. This involves designing a risk management strategy and detecting potential risks, such as market instability, changing client tastes, and legal difficulties. Additionally, entrepreneurs should also consider possible advantages, such as improved revenues, increased market share, and increased brand awareness. By knowing the risks and rewards associated with their firm, entrepreneurs can make informed decisions about how to deploy capital and manage their business's growth. Raising money and investments phases. There are normally 4 primary stages of investment: seed stage, early stage, growth stage, and exit stage. During the seed stage, entrepreneurs often rely on personal funds or money from family and friends to get their firm off the ground. In the early stage, entrepreneurs may seek out angel investors or venture capitalists to give cash in exchange for equity in the company. During the growth stage, entrepreneurs may seek for extra money to help their business scale, maybe through loans, crowdsourcing, or private equity. Finally, during the exit stage, entrepreneurs may contemplate selling their company or going public through an initial public offering, IPO, in order to obtain a return on their investment. When it comes to generating money for a startup, entrepreneurs may apply a range of tactics. One popular technique is to produce a complete business plan and pitch it to possible investors, showing the potential for growth and profitability. Additionally, entrepreneurs may seek out incubators or accelerators, which give cash, mentorship, and resources to help enterprises expand. Crowdfunding is another popular technique, which involves gathering funds from a large number of individuals online, generally through social media or crowdfunding platforms. Regardless of the strategy adopted, entrepreneurs must be prepared to demonstrate the potential for profitability and define their vision for the future of the company. By understanding the many stages of financing and how to raise money, entrepreneurs can ensure they have the financial resources they need to take their startup from zero to hero. Understanding valuation is a vital facet of a startup's financial journey, since it establishes how much the firm is worth and is used to raise money from investors, negotiate partnerships, and facilitate prospective acquisitions. Valuation is essentially an evaluation of a company's current or possible future worth based on several aspects, such as its current financial performance, market size, competitive environment, and growth potential. There are numerous approaches of valuing a startup, including the market approach, income approach, and asset-based strategy. The market strategy analyzes market data to compare the startup to similar companies, whereas the income approach focuses on the present value of future cash flows. The asset-based approach, on the other hand, evaluates the worth of a company's assets, such as real estate or intellectual property. In addition to these valuation approaches, there are other various measures that investors use to determine the worth of a startup, such as revenue, earnings, user growth, customer acquisition expenses, and lifetime value. These metrics can be used to help identify the right valuation for a startup. The valuation of a startup can have a substantial impact on the amount of money that it can raise from investors, as well as the terms of any investment. For example, if a startup is valued at $10 million and an investor offers to invest $1 million, they would be obtaining 10% of the company in exchange for their investment. However, if the same investor agrees to invest $1 million in a firm valued at $5 million, they would be receiving 20% of the company in exchange for their investment. It's crucial for entrepreneurs to understand how valuation works and how it can affect their business. A high valuation might help attract investors and raise more money, but it can also put pressure on the startup to continue to perform and develop at a rapid rate. Additionally, a high valuation can make it more difficult to sell the company or attract possible acquirers, as the price tag may be too high. Investing in the proper resources. In order to prosper, entrepreneurs must invest in the appropriate resources. This includes investing in the proper people, such as recruiting knowledgeable and competent personnel. Additionally, entrepreneurs should invest in the necessary technology and equipment to ensure their business is working efficiently and effectively. Finally, entrepreneurs should also invest in the correct marketing and advertising tactics to ensure their business is reaching the right audience. Building a financial strategy. Once entrepreneurs have identified the right resources for their business, the following stage is to establish a financial strategy. This involves creating financial goals and recognizing the financial ramifications of their decisions. Entrepreneurs should assess their short-term and long-term goals and establish a plan to accomplish those goals. Additionally, they should assess the potential risks and benefits associated with their decisions and build a plan to reduce those risks. Finally, businesses should also set a budget and manage their expenditures to ensure they are remaining on track with their financial goals. Setting financial goals is vital for any startup. This requires comprehending the financial ramifications of their decisions and identifying what they want to achieve. For instance, business owners should think about their ideal cash flow, profit margin, and return on investment. Entrepreneurs should also take into account their target market share and growth rate. By creating clear and quantifiable goals, entrepreneurs may guarantee they are taking the correct steps to attain their financial goals. Options for exit. An essential component of a startup's financial journey is comprehending exits. An exit refers to the point at which the founders and investors of a startup can sell their shares for a profit. There are various sorts of exits, including initial public offerings, IPOs, purchases, and mergers. An essential component of a startup's financial journey is comprehending exits. An exit refers to the point at which the founders and investors of a startup can sell their shares for a profit. There are various sorts of exits, including initial public offerings, IPOs, purchases, and mergers. One of the most well-known departure strategies is an initial public offering. In an IPO, a firm issues shares of stock to the public for the first time, allowing the public to invest in the company. IPOs can be a means for startups to acquire considerable sums of capital fast, and they can also provide early investors and founders with an opportunity to cash in on their investments. Developing financial literacy. Finally, entrepreneurs should also spend in enhancing their financial literacy. This requires comprehending the principles of business finance and learning the language of money. Additionally, entrepreneurs should also stay up to date on the current developments in corporate finance and understand how to use financial instruments, such as financial spreadsheets and business analysis software. By enhancing their financial literacy, entrepreneurs can make smarter decisions about how to deploy capital and manage their business's financial performance. From understanding how to appropriately spend finances to ensuring adequate cash flow, entrepreneurs must be able to navigate the ever-changing business landscape in order to effectively traverse their financial path. With the correct coaching and resources, any entrepreneur can take their firm from zero to hero and attain their financial goals. If you were inspired by this video, let's hear from your opinions in the comment box below. And remember to subscribe, share, and hit the notification bell for more exciting videos. Thanks for watching. See you in our next video.